Hey everyone, when I analyze the commercial real estate market, the most important consideration is what's happening with the underlying supply and demand fundamentals. As long as new demand outpaces new supply, vacancy rates go down, rents tend to go up, and all is good. A lot of the focus in this analysis is spent on the demand side of the equation. Key factors include job formation, population growth, household formation, changes in household incomes, migration patterns, and so on. But there are two sides of the supply and demand equation. Even if you have fantastic demand drivers, commercial real estate fundamentals can still weaken if development grows faster than demand. This is something that happens quite often late in a growth cycle. And entering 2023, each property type faced a unique outlook. While the office development pipeline for 2023 is relatively thin with about 1% inventory growth, the demand side of the equation is even more thin. As a result, office vacancy rates are on the rise in every major market across the country. Retail construction is even thinner than office, with about 0.5% of inventory growth expected this year. And the majority of the retail completions will be single-tenant build-to-suit locations. At the same time, retail space demand is relatively strong. Vacancy rates have been trending downward for 2 years now, and they're back into alignment with pre-pandemic levels. In addition, rents have been rising by about 4% and now stand nearly 10% above where they were at the end of 2019. Apartment construction, however, was expected to reach a record 400,000 new units in 2023, an inventory expansion of 2.1%. That said, several developers have recently told me that their projects are behind schedule and their completion dates are slipping. They mentioned that they're still facing shortages of labor and construction supplies that are stretching out their timetables and construction costs. That will likely defer some of the expected completions into 2024, a positive for the apartment supply and demand balance. Over the last year, apartment vacancies have been on the rise. This mostly reflects sagging consumer sentiment caused by the high inflation climate that ultimately stalled household formation. The good news is that sentiment appears to have hit a trough in mid-2022 and has mostly been rising since. That's not to say that we couldn't hit another soft patch this year, especially if there's a recession, but the trend has been going the right direction for several months now. The industrial sector also entered the year with a record development pipeline, with 400 million square feet of new space expected and inventory growth of 2.3%. But it appears the pace of completions may also drag out a bit for the same reasons that apartment construction is slowing: labor and construction material shortages. Once again, this is a positive for existing operators as the absorption of industrial space has begun to lose some momentum. The taper of industrial space demand is likely a relatively short-term phenomenon. Retailers are shrinking their safety inventories because supply chains have been getting better. But retailer expansions and new store openings, together with still robust e-commerce sales, should revive industrial demand next year. So if the volume of new industrial completions eases a bit in 2023, then revives in 2024, the space additions may align with new space demand pretty well. Looking forward into 2024 and 2025, commercial real estate completions should taper. The cost of construction loans have pushed up into the 8% or higher range, which is too high for most projects to pencil. As a result, new commercial real estate construction starts have been declining. Considering that most projects tend to have a prolonged construction time, often a year or more, the volume of completions next year will likely ease. Basically, builders are putting projects that haven't already started on hold until the cost of capital comes back down. That's not to say that these projects won't be built eventually, many of them will. But a slowdown in completions will allow existing commercial real estate properties to sustain their operations without the risk of a significant wave of new development. Unfortunately, the net decline in office space demand won't be helped much by the thin development pipeline. But the supply and demand outlook for apartments, retail, industrial, and most niche property types remain promising, especially on a longer-term basis. And that's where investors should be focusing, the longer-term outlook. As always, investors need to keep their eyes on the horizon.